Yield curve. Maturity. Yield. Yield means return, YTM. If nothing is mentioned, normally interest rates are higher for longer dated bonds and lower for shorter dated bonds. It has no link with the duration. Duration is another concept. This is another concept. If you are buying 10 years bond, okay, if you are buying 20 years bond compared to 10 years or 5 years, 20 years bond return should be higher compared to 5-year bond. Otherwise, no one will buy. No one will buy. Yeah, this is another concept. If nothing is mentioned, longer maturity bonds have a higher interest. I'm not talking about duration. I'm talking about interest. And it's a common sense. If you're putting your money for 5 years, you will, for example, expect 10% return. But if you're putting your money for 20 years, you will expect higher return. Okay. Next. If you're not expecting anything, this is the graph of yield curve. If you're expecting that interest rate will go down, this graph will be, this is inverted yield curve. If you're expecting that interest rate will go down, so the yield curve would be lower. If you're expecting that interest rates are go down, longer maturity interest rate will come down. Sir, why, sir? Why longer maturity interest rate will come down? Look, if you're investing in 1 year, interest rate would be, YTM would be 10%. For example, you are expecting interest rates are coming down. You are expecting that interest rates are coming down. My question, will you invest in short term or long term? Ignore the interest. Ignore the YTM. You are expecting that interest rates are coming down. Will you invest short term or long term? If you are expecting that interest rates are coming down, will you invest short term or long term? Simple question. Everyone, please answer. Okay. Listen my answer. If you are expecting that interest rates are coming down, your wish is to invest for long term. There is no floating bond. We are talking about fixed rate bond. There is no such thing floating rate bond. We are talking about fixed rate bond. This yield curve is only fixed rate bond, not for the floating rate. Ignore the floating rate. So remember, if you are expecting that interest rates are going down, we will invest in long term. Why? In order to catch this current interest rate for longer term. In order to catch current interest for long term. Nobody will invest in short term. Everybody will go for the long term bond if interest rates are going to down. So this bond will become expensive. Its price will go up and its price will go down. बात समझ आ रही है ना? Why you will go for long term? Because you want to catch the current interest rate. In order to catch current interest rate for long term. Because currently interest rates are higher, but it will go down. You're expecting it will go down. So everyone will invest in long term. Nobody will invest in short term. अभी डाउन हुए नहीं है, इट विल गो डाउन. फॉर एग्जाम्पल करंटली इट इज 20%. It can go to 15, it can go to 10. So according to you, invest for short term for 1 year. Short term 1 year. 1 year में you will get 20%. One year you will get 20%. After 1 year, what will happen? After 1 year, interest rates are lower. You will invest now at lower rate. And this is a loss. अच्छा, ये पहले ये आपकी स्ट्रेटेजी. नाउ लुक एट माय स्ट्रेटेजी. Invest for long term. Now, to get higher interest rate today. Okay. So your strategy is, for example, this is a 5-year period. Your strategy is invest for 1 year. Sir, I am investing for 1 year at 20%. So after 1 year, what will happen? Interest rate, for example, moves to 15%. Now you will invest at 15%, then you will invest at 10%, then you will invest for 7%, for example. Your overall return go down. What I am doing? I am investing for 5 years at fixed rate. Even interest rates go down, I don't have any fear because I have locked my interest rate for 5 years. So therefore, remember, whenever you are expecting that interest rates are going down, you will always invest for longer term. Okay. So conclusion, if you are expecting interest rates are going down, invest for long term. Let me give you a practical example. In Pakistan, 3-month, 6-month, 9-month, and 12-month bonds were available. 3-month interest rates are higher. 6-month, 12-month interest rates are lower. It was near to 21%, and it was something like 23%. So if you are a dump, or let me put in a professional way, if you're not a finance savvy, you're not a finance person, you will say, sir, don't invest here, invest here. So you will get 23%. But what will happen after 3 months? If interest rates went down, they will cut the interest rate of every bond. Because currently, in this year, if you look at the news, every government is expecting to cut the interest rate. Even Pakistan has cut the interest rate in last month. So that's why I have invested for long term, comparatively long term, in order to lock my rates. Right? Okay. Now my question. If you're expecting that interest rates are going up, then what you will do? If you are expecting that interest rates are going up, then what you will do? Then we will invest for short term. Why, sir? Sir, interest rates are going up. We will invest for short term. We will wait that interest rates should go up. And once the interest rates are higher, then we will invest. Otherwise, we will invest for only short term. Clear?